A C corporation is a legal entity separate and distinct from its owners. Owners are called shareholders, and shares of stock are evidence of corporation ownership. The company's articles of incorporation state the number of shares that can be issued or authorized. C corporations need to have articles of incorporation. These articles are the rules by which the corporation can operate, and they must be prepared and filed with the appropriate agencies before the corporation begins functioning as a trade or business. Control depends on stock ownership. The stockholders may or may not be business managers. Usually, it is a good idea to get attorneys involved in creating the articles of corporation. A person or group is able to make policy decisions when they control 51% or more of the stock in a corporation. Corporations must have regular board of directors meetings as well as an annual stockholders meeting, and accurate records of these meetings must be maintained. These same rules also apply to S corporations, by the way. The board of directors will direct the corporation's operations. Records must be kept to document decisions made by the board of directors. Corporate officers and directors can be held personally liable to the stockholders for improper actions. This liability is usually limited to their stock ownership, but in the case of fraud, it can extend to the individual's personal assets as well. Sole proprietors who provide services to their business and decide to incorporate become employees and are then subject to the payroll tax filing requirements. These additional requirements and the record keeping involved are frequently a problem for officers of corporations. So you need to consider all of these factors when advising clients who are considering becoming or changing to a corporation. As a tax preparer, you'll have an opportunity to help your clients comply with these regulations and requirements. Of all the business entities we have discussed so far, a C corporation is the first one that reports and pays its own income tax. To calculate the taxes for a C corporation, the tax preparer completes a Form 1120. The form has a place to calculate the income tax from a separate corporate tax charge, and payment will be submitted quarterly or with the form, if required. Corporations have centralized management. All management responsibility is assigned to a board of directors, which appoints officers to carry out the corporation's business. Centralized management is essential to smooth operation of a widely held business. The profits are taxed to the corporation when they're earned, and they will also be taxed to the shareholders when distributed as dividends. Hence the term double taxation. For example, ABC Corporation had income of $500,000 on which it correctly reported and paid corporate income tax. Later, the corporation distributed that income as dividends to their 10 shareholders, who also had to report the dividends as income on their personal returns and pay tax on it. Therefore, the same income was reported and taxed twice. Now for some advantages. C corporations are separate legal entities. Obviously, the death of an individual stockholder does not affect the corporation's longevity. Selling shares of stock easily transfers ownership. Corporations often have a better opportunity to raise capital than partnerships or sole proprietorships. There's a limited liability from corporate creditors, and the owner's liability is limited to the amount invested in the company. Shareholders under state law are generally shielded from the corporation's actions and debts as long as there is no fraud involved. As mentioned at the beginning of this session, however, a shareholder could have liability if he guaranteed a loan. Also, officers of a corporation can be liable to stockholders for improper behavior. A C corporation does have its tax advantages as well, such as the ability to offer tax-advantaged fringe benefits to employee shareholders, deduction in full of passive losses, and the option to adopt a fiscal year instead of a calendar year. Fringe benefits such as health insurance, medical reimbursement, travel, education, and group term life insurance can be paid and deducted by the corporation to all employees, including employee shareholders, as long as all rules for eligibility are followed. What are the disadvantages? The biggest disadvantage of a corporation is the double taxation of the profits that I alluded to a moment ago. The individual shareholders may not deduct losses sustained by the corporation. Corporations are more expensive to organize and register, and they are highly regulated at all levels of government. Also, the requirement to hold regular board meetings and maintain corporate minutes can be very burdensome.